Hello, Paul Gerard from Price Accounting Services, and welcome back to this video in our SMSF channel. And this video is going to discuss the limits of a self-managed super fund and some of the key rules. These are important things for anybody considering a self-managed super fund to understand, and this video by no means tries to cover all of them, okay? But it's a good start point to clear up a lot of misconceptions and get some understanding about what is allowed and maybe what's not allowed. So one of the key limits of a self-managed super fund is it must always be maintained for the sole purpose of providing retirement benefits for the members. So that's the sort of like a governing rule that surrounds the framework of self-managed super funds. And it's a foundation to many other rules within the laws. And it governs things like that stops the members borrowing from a self-managed super fund. It's just not allowed, okay? And using the self-managed super fund money for any purpose other than an investment, such as temporary borrowings by the members or lending it to a business or something, are absolutely prohibited and are subject to very harsh penalties. At the end of each year, the fund has a compliance audit. It governs things like making sure that that has not occurred. And if it has, the auditor is obliged to consider and even to lodge a contravention report with the ATO. And that can give rise to all sorts of penalties, the worst of which can be jail, but in most cases it can include banning members from being a trustee for a fund, winding up the fund, monetary penalties, or what I call the education camp approach, where the tax office will send off the trustees to be re-educated and learn more about the laws. And that's probably the least problematic outcome, okay? So the limit of self-managed super funds often come down to some of the governing rules. So for example, Section 66 of the SIS Act, which governs superannuation law, says that a fund must not acquire an investment from a member. Now, there are exceptions, okay? And the exceptions can be read and are very limited. So for example, Section 66 does limit a acquisition of an investment from a member where it is a listed security acquired at market value. So let's say mum and dad own some Telstra shares and they acquire them back day dot, and now they're worth, pick a number and say $5. Then provided that the fund buys them from mum and dad for $5, or they're transferred in specie using the cost of $5 as the value, then that's perfectly acceptable. But one key rule which many people are very surprised about concerns property. A fund may not acquire property from a member unless it's commercial use, business, real property. So, and I'm often queried about this is why. And I guess it's an avoidance rule. That's all I've ever been able to determine from all the old laws when it was implemented, etc., that the government saw fit to just stop people from the sale of residential property. So if you own residential property, you own a block of flats, and it doesn't matter what, why or how, you cannot sell that to a self-managed super fund, transfer it to a self-managed super fund, even if it's a form of contribution, because it's prohibited, okay? So then there's prohibition around what the fund can do. So we've already touched on the investment strategy for a self-managed super fund, and that investment strategy is contained in Section 52, which says the fund must maintain and give consideration to an investment strategy and maintain that from time to time. And then it also says the fund must also consider insurances for the members. Now that could be as simple as a resolution that says the members do not require insurance. Full stop. Simple. Okay? Considered it. The members don't want it. So Section 52 forces some governing rules onto a fund, even if it doesn't have those rules in its own documents. the limitations of the investment strategy limit what are approved investments. So, for example, if the trustees have decided that they don't seek to buy US listed shares, let's use that as an example, then Dad can't turn around tomorrow and decide to buy shares in Tesla. Okay, the investment strategy would need to be changed, mutual consent of the members or trustees. So remember, the members are the trustee directors and so on, before that investment could progress. Okay, and that's a protective mechanism. There's also a few little laws in there concerning coercion. It's actually a criminal offence to threaten a trustee, and I have heard in court cases where family disputes have escalated into a breach or a breakdown in the manner in which a self-managed super fund is governed. And one of the limits is you may have to go to the Supreme Court to get orders, and that's expensive. Okay. However, if you can mutually agree to wind the thing up and go your own way, that's a much safer, cleaner, and far cheaper path. Okay. So that sort of touches on some of the key rules. So no borrowings. Now, let me just touch on borrowings for a minute. We've got another video in this channel on self-managed super fund borrowings because some borrowings are permitted. Okay. So an example of what is permitted as a borrowing might be a temporary indebtedness to a broker to settle securities which are being purchased under contract. So an unsettled purchase of listed securities, for example. If it takes a couple of days to pay, then that is an exception. And it's just a logical exemption to put into the Act just to make things workable. Okay, because otherwise, technically speaking, there's a borrowing or something like that for those couple of days before settlement. Okay, but generally SMSFs can't borrow, but there is specific provision in the laws for a number of years now, but it's very restrictive in the manner in which a fund can borrow. So a fund can't just go along to a bank and take out a loan. It doesn't work that way. So our video on borrowings will address the specific method, but using what's called a limited recourse borrowing facility, that type of arrangement is permitted. Okay, so it is a key rule and it's a key limitation. So I hope that sort of explained just some of the issues surrounding SMSFs, particularly the one about using the funds personally. Often find problems there. However, let's just touch on one further positive to that. So let's say the self-managed super fund buys a property to lease to the business. That is completely acceptable provided there's a lease and it's all on market terms, etc. And so it opens up a lot of strategies where you can actually create your own investment strategy where your fund can assist to fund part of the business. So if you've got any thoughts around that, it's worth discussion. So it might be a sign that maybe you've got an idea about the use of a self-managed super fund. With a little bit of advice, we can sort of steer that in the right direction and tell you whether it works, doesn't work, or not. Lots of ways things can work, okay? So look forward to maybe speaking to you, but otherwise look forward to you enjoying one of our other videos in this thread, this channel, and we'll see you soon. Cheers, bye.